Good afternoon, everyone. Welcome to our first quarter webinar event. We're happy to have you all here today. We know it's been an eventful first almost 4 months to start the year since we last spoke with all of you at our annual outlook. We're going to cover some updates to that outlook today for financial markets, the economy, what we're doing for client solutions and in our investment strategies, and more. My name is Gerald Guger, Head of Content Strategy at Manning & Napier, focused on bringing you the unique views and perspectives of our firm. And I'm excited to be joined here today by Chelsea Seibel, a financial consultant in our wealth management group and a recent addition to Manning & Napier. She brings over a decade of experience in the financial services industry, working at both large institutional and smaller boutique firms, providing planning strategies and investment solutions across the full array of client needs. And like Greg before 3 months ago, she joins us from Florida. So I'll ask her not to comment on the weather, as I am very sure I saw snowflakes outside this morning. Chelsea,
Thanks,
welcome.
Thanks. I have the background, so you can't see the palm trees in the background.
And I'm also joined here today by Kelly Covley, an analyst within our quantitative strategies group, joining us first as an intern back in 2014 from Hamilton College and staying with us all the way through to today, where she is now responsible for setting the firm overview on all things macroeconomics, financial market outlooks, asset allocation, and more. Kelly, we're really happy to have you here today.
Thank you, Jerry. Happy to be here.
Our agenda today is as follows. First, we're going to dive right into one of the, if not the major issue that we know is on so many of your minds, and that's inflation and its ramifications for the economy, financial markets, and everything else. We're then going to walk through our action plan, both within what we're doing for investment strategies right now and not doing, as well as what we're doing in overall financial plans. And we know inflation is not the only worry that's out there. So we've created a bit of a wall of worry section where we're going to talk about a few of those other risks that are out there in the markets and the economy as well. And after that, we'll do live question and answer. And as a reminder, we encourage all of you to submit any questions you may have throughout the event by clicking on the Q&A box on your screen. And so with that, let's get into it. And to start, I'd like to turn it over to Chelsea to talk about a theme for today's event. Chelsea?
Thanks, Jerry. In my opinion, there is no better way to start a presentation than with the wise words of Warren Buffett. And this quote, "The most important quality for an investor is temperament," is one of those things that is easier said than done. If you watch the news or read the paper, we get a lot of messaging, and that messaging is meant to catch your attention and often cause concern. This quote is so important because it really drives home the importance of having a plan so that you can remain calm during periods of uncertainty. If you invest your portfolio based on the headlines, you will always lose. The people who experience the most financial pain are those that take extreme action getting in and out of the market. While there are always risks with the market, staying invested remains paramount. We look forward to adding some color to some concerns we've heard from the field, and I'm excited Kelly is joining me to explain what our research team is doing to tackle some of these issues.
Yeah, absolutely. Temperament, it's just such a calming phrase amid a bunch of rising risks out there, but of course, chief among them is inflation. So Kelly, let's dive into it. Let's talk about inflation. I know it's a lot higher than it used to be. Can you give us some context around what's exactly going on there?
Sure thing. So it's definitely at the forefront of investors' minds, but inflation really impacts everyone, whether they invest or not. Paying more at the pump and at the grocery store at this point, I think, is quite noticeable and definitely really not enjoyable. And today we also have a lot of professional investors and everyday people who haven't experienced inflation like this, at least in their adult lives. And that can be really kind of a shock to the system. And this is one spot where that even temperament becomes really important because it can feel really unprecedented to those who haven't experienced it before or haven't experienced it in a long time. But looking back over the long-term data, we can see it has occurred before at times, even at higher levels. And none of these are necessarily perfect historical parallels, but they can guide and inform us to some extent. And at this point, our base case is for inflation to probably fall from here, but perhaps not quite as quickly as policymakers might want it to.
Yeah, well said, Kelly. Inflation has been quite evident in our everyday spending. There seems to be an extra digit on my grocery store bill these days. And even though average hourly wages saw increases, they haven't kept up with inflation, which has made it a little bit more painful. We've also seen how extreme inflation has been very detrimental to the economies of other countries like Venezuela and Argentina. Kelly, do you believe we're at dangerous levels, and how do you think we can gain control without upsetting the market?
Sure. Yeah. So a little bit of inflation is desirable and the sign of a healthy economy. So the Fed's target rate of inflation, for example, is around 2%. But to your point, at higher levels, it can start to cause some problems. And that's why policymakers seek to stabilize inflation. And fortunately, they do have some very powerful tools at their disposal to do that. One of those policy tools, I'm sure you've seen in the news, is interest rates. So the Federal Reserve has started bringing interest rates up a bit to help tamp down inflation. On the table here, you can see US Treasury rates increased from the end of 20 to the end of 2021. And then this year, that's really accelerated, really across all different maturities. And historically, hiking rates like this has been quite effective at bringing down inflation. We're essentially increasing the cost of borrowing. So consumers might be less inclined to buy that house if they have to take out a more expensive mortgage. Companies might avoid buying capital equipment because they'd have to issue debt to buy that capital equipment. But this does put the Fed on a bit of a tightrope, because essentially what they want to do is soften demand enough for inflation to come down to more desirable levels, but not so much that the economy tips into a recession.
Yeah, it does seem like quite the balancing act. And now, what stage the economic cycle that we do this balancing act is just another layer of complexity. And just to clarify, when we refer to the economic cycle, we are referring to the overall state of the economy as it goes through the four stages. We have expansion, peak, contraction, and then the trough. Varying factors such as GDP, interest rates, total employment, consumer spending can help determine the current stage of the economic cycle. Okay, Kelly, I have a few questions for you here that kind of go hand in hand. In your opinion, where do you believe we are in the cycle? Do you believe we are behind the curve in raising interest rates? And where are you seeing the differences from prior hiking cycles?
Yes. So first of all, some of those factors you mentioned in determining where we are in a cycle are really, really important, because with economic cycles, we always want to measure them by conditions rather than the amount of time you've been in a cycle. One way to illustrate this, the expansion following the 2008 crisis was a really slow and drawn out recovery. It went on for many, many years, well above the historical average. And this recovery so far seems to be pretty much the exact opposite. The economy recovered really quickly off of its bottom, partly because of how much stimulus was so quickly pumped into the system. And we, again, pretty quickly started to see really strong jobs numbers, strong wage growth, and those inflationary pressures. And all these factors are typical of a later cycle environment. And historically, the Fed has started to raise rates when those late cycle signals weren't quite to the point where we are today. So let's take inflation to illustrate that. In recent history, at the time of the first rate hike, inflation had been on average 2.6%. This time around, it had already reached 6.4% when the Fed made that first rate hike. And the fact that inflation is so high doesn't mean that, they won't be able to bring it down, but it does mean potentially that those rate hikes might have to be a bit more aggressive, a bit more rapid fire than they typically would be, which poses a bigger risk to economic and market growth.
That may sound a little concerning for clients. Does that mean we are predicting an imminent recession?
So we think risks have started to build, and we've adjusted our positioning accordingly. But at this point, an imminent recession isn't our base case. There are some external forces out there that could help the Fed bring inflation down without that negative impact on demand. So supply chain issues could continue to ease a little bit. Workers could keep rejoining the labor force, acting as a bit of an outlet for some of that upward pressure on wage growth that we had been seeing. So again, it's not necessarily an environment where you want to run for the hills, but it is one where risks have started to build and it makes sense to get a bit more defensive.
Okay, so we're not running for the hills, but this quarter has seen an increase in volatility. Since we know that the market tends to be forward thinking, do you think that the market has already priced in these risks?
Yeah, so we've seen that volatility and fear starting to make its way into equities, but it's really not close to the degree you would see if the market were pricing in an imminent recession. We're not seeing signs of investor euphoria like you would see in a bubble, but broad equities as a whole actually are still on the expensive side relative to history. This chart here gives you an idea of the historical range of the market's price to earnings ratio. A higher number here basically means things are more expensive. And this dark blue line is the historical median from 1999 to today. And as you can see, today's reading, that light blue diamond is decently above that historical norm.
So it's good to hear stocks are not at bubble territory, but they certainly aren't cheap. What about on the bond side? Are we seeing any better value in bonds?
Yeah, on the bond side, yields have started to come up, but they're still pretty low for safe bonds like treasuries. And in addition to this, at this point, you aren't really getting all that much extra return from riskier borrowers like corporations. There certainly still are opportunities out there, but they tend to be a bit harder to find. And then the rising rate environment also can put bondholders in a bit of a tough spot because of that inverse relationship between yields and bond prices.
Yeah, let's pause and revisit this concept of an inverse relationship, as this can be a confusing concept for many investors. An example I like to use is, say you currently own a bond that pays you 3%. Interest rates have now gone up, and you can now buy a bond that pays an investor 4%. If you wanted to go sell your bond, you'd have trouble, as someone would prefer to receive 4% over your 3%. The way to make your bond more attractive is you'd have to discount the price of the bond to make up the difference when it's redeemed. So interest rates go up, price of bonds go down.
Yes, that's a perfect illustration. And I do want to add on that those rising yields can be bad for bond prices in the short term, but it does at least set the stage for better future returns and more compelling opportunities down the line.
So having briefly covered our economic outlook and on the economic cycle and inflation in particular, and then talking a little bit about some of the headwinds and challenges we see in both the stock market and the bond market on the fixed income side of things, let's talk a little bit about kind of the action plan, right? So what do you do about that? What are we doing about that on behalf of all of you? And that is both on the portfolio and on the planning side. Let's start first maybe with investments, and at a really high level. Chelsea, can I turn it over to you to kind of cover how we're thinking about putting these views into practice?
Yeah, absolutely. Our investment strategies are designed with the belief that fundamentals win out over the long term. If you look at this quote, we are not speculating. We are using a process based on data. We have a varied toolkit to protect our investors, but also provide superior returns. And some of those tools we use include using asset allocation, shifting to and from equities and fixed income, using sector allocation shifts, both on the equity and fixed income side, and then making individual security selection. And we're able to use these tools as active managers to benefit our investors. Considering our economic outlook and the elevated state of valuations across asset classes, we believe that a relatively balanced asset allocation is appropriate at the moment. We expect to remain flexible and opportunistic, and we're really focusing on that trade-off between risk reward as that economy moves into later stages of the economic cycle. Additionally, we've incrementally reduced equity exposure with particular focus on cyclical companies that may suffer more during an economic slowdown, and really focusing our portfolio on the highest quality profiles. And all of these moves echo our time-tested 52-year-old process for focusing on the long-term investing. It's important to de-risk portfolios and make tactical decisions for investors. Kelly, can you explain what we are doing on the fixed income side of things in portfolios?
Yeah, so you mentioned focusing on this trade-off between risk and reward, and that is certainly the case within our bond portfolio. We really want to be careful to make sure we're being compensated for any risks we're taking on. So today, that means avoiding some of the areas that would be the hardest hit by rising rates, and also avoiding some areas like those riskier corporate borrowers who aren't necessarily paying much higher yields to compensate for that risk.
And I just want to summarize what you said here because I think it's important. For individual investors, it can be tempting in low interest rate environment to reach for those higher yields with riskier corporate borrowers. But what you're saying is this is really the time to avoid those borrowers.
Yes, and it's not to say you have to avoid the whole area, but you do need to be selective, even in this environment where overall yields have started to come up a little bit, but still remain pretty low relative to their longer term history.
So with yields so low, and I hear this question frequently in meetings, why do we own bonds?
Yes, so we think bonds still play a really valuable role in portfolios by providing downside protection. And in a sense, these low yields do increase the cost of that downside protection. And that's a trade-off we're always actively considering when we're positioning our portfolios. But bonds and even cash can be really valuable in times of volatility because in addition to providing that protection on the way down, they can also be deployed quickly into the compelling opportunities that do pop up in a downturn. And volatility gets a bad rap, but those really are the times our analysts get the most excited because it gives them opportunities to buy great businesses at attractive prices. And having an appropriately sized defensive and liquid portion of the portfolio allows us to take advantage of those opportunities really quickly when they do come up.
And speaking of opportunities, despite our outlook becoming more cautious over the past year, we are still continuing to find good bottom-up investment opportunities for long-term investors. We continue to see value in certain economically sensitive areas, as well as what we believe are best-in-class companies in a variety of industries like life sciences and consumer staples. One example in the life sciences is IDEXX. It's a company focused on animal health, which we started purchasing in March of 2020, right when COVID hit. And let's be honest, biggest winners of COVID are our pets. I know personally, my dog has loved the fact that I'm working from home. So instead of talking to colleagues, I've resorted to belly rubs and playing fetch, and I'm sure many of you can relate. Animal health has shown historical defensiveness in times of economic weakness because as pet owners, we prioritize spending on our animals. Consumer staples also tends to be a more defensive sector as they are non-cyclical. Some of these names you may recognize are Heineken, Coke, Mondelez, Unilever. I'm going to call myself out, and in addition to hanging out with the dog, working from home lends well with snacking. It's hard to walk through the kitchen without grabbing something tasty along the way. Heineken, Coke, Mondelez, they all have strong pricing power. Those knockoff Oreos just don't taste the same. Heineken has also positioned itself in faster growing geographies and product segments. Our team also believes in the long-term prospects of several growth-oriented industries, which I'll let Kelly cover.
Yeah, in the tech and communication services space, there are some really compelling businesses that are well-positioned in areas of long-term secular growth like cloud computing. And these are long-term trends that we expect over the long run are going to march on regardless of economic or market volatility. That said, some of these companies are a bit more exposed to economic growth in the short term. And for companies where that's the case, we have incrementally reduced exposure as fundamentals and valuations have evolved. Within tech, we're also interested in companies here that are dominant in their industries. So one good example is payment processing or credit card companies. And here, these are businesses where their customers probably don't have many great alternatives other than cash. And I don't know about you, I'm not the best at carrying cash with me, so I really need to use that credit card. And this pricing power arises because their customers, they basically need to offer the credit card if they want their customers to be happy. So in an inflationary environment where costs are increasing, it's really valuable to have pricing power because your customers are more likely to tolerate a price increase. And we have some exposure also to some other perhaps less exciting companies with impressive pricing power in the North American railroads. Railroads are incredibly capital intensive. They spend billions of dollars a year just in maintenance, and this makes it nearly impossible for a new entrant to come in and compete with the incumbent companies. And what you end up with then is a really consolidated industry where, again, the companies have bargaining power over their customers, and that gives them some degree of pricing power. And finally, moving on to logistics companies like the railroads, they have extensive physical networks built out, which helps give them pricing power. And they're also benefiting from some of the supply chain pressures that we had been seeing. Inventories for a lot of companies got pretty depleted, and they're now kind of playing a game of catch up, trying to rebuild those inventories. And that helps continue to fuel demand for the logistics networks.
Thanks, Kelly. I'm going to expand on that railroad theme. We all know that investments are what ultimately fuels the engine. We have to make sure the tracks are in place. Let's take a look at other factors that can impact a financial plan. From the fiscal and monetary legislative side, the big news to announce in 2022 is that there isn't a lot of news. Last year, during President Biden's first year in office, there was a lot of attention placed on noteworthy tax changes via the Build Back Better Act. And despite efforts to compromise, the act stalled in Congress. So these potentially dramatic changes in tax and retirement planning turned out to be a false alarm. However, there are still some noteworthy adjustments in 2022 for inflation-adjusted tax brackets, phase-out ranges, and contribution limits. And this is a good time to put a little plug in for our first edition of our complimentary 2022 Tax and Wealth Planning Guide. And it's what you'll see on your screen. It's very comprehensive. It's 60 pages, but it is a fantastic way to optimize your tax strategy for the year ahead. It can be found on our website, and I believe we will be sharing a link in our chat. I also like to note that the end of tax season is a great time to come back to your overall financial plan. There are many components that need to be coordinated for a successful financial plan. For example, when is the last time you reviewed your estate plan? It's important to make sure your plan is current, especially if there's been a life event. This includes your will, trust, durable financial power of attorney, healthcare proxies. You want to make sure they're all current. And part of this process includes checking beneficiaries on all accounts and insurance policies. These beneficiary designations, a lot of people don't realize, supersede what you indicate in your will. So that's important. And then have any of your goals, objectives, spending habits changed? If so, this is a good time to speak to your financial advisor to make sure your investments are aligned. And then if you're still working, are you increasing or maximizing your retirement contributions? And if eligible, your HSA contributions. But bottom line, it's important to be checking those mile markers to make sure you're on track for financial success. So moving on to our performance, and first, usual disclosure, we are showing the full market cycle in this slide. And this is important because if you only focus on short-term performance, you may miss some of the fundamentals we implement as an active money manager. When we see progression in the cycle, it may make sense to scale back on risk so that we can ultimately take advantage of those recoveries. And let me explain what I mean by that. So this chart starts January 2020, of course, pre-pandemic. S&P 500 hit highest peak February 19th of 2020. At that point, we had already started scaling back some risk. When COVID hit, it allowed us more protection and then able to put more capital to work and take advantage of that upside. So we're very proud of our results. You can see on the chart that we beat the benchmark in all of our strategies. This quarter, we're seeing an increase in choppiness, but just remember that we were looking at the cycle as a whole because that is what will benefit our investors in the long run. Kelly, how has the research team handled not just the pandemic sell-off, but the choppy year so far?
Yeah, there have been a lot of different market regimes in these 2+ years we're showing here. We had a pretty exceptional downturn, an exceptional recovery, and now some more recent market choppiness. So a lot of different environments, but really in any of these, or pretty much any environment you could possibly think of, they have one important thing in common at least, which is in order to be successful, you have to avoid getting caught up in the emotions of the market cycle and following the crowd. So regardless of where we are in a cycle, we're constantly on the lookout for risks or opportunities that the market might be underestimating. When the market is underestimating some of the risks out there, like we're starting to see today, that's when we want to start to get more defensive. And assessing this in real time can be difficult. And that's where advanced preparation and a long-term perspective really come in handy. Our analysts have a really deep knowledge of their coverage area. They've been following their companies for years and years, so they really know the long-term stories of these businesses like the back of their hand. And that gives them the ability to really quickly parse out what does or doesn't matter for the true intrinsic value of their companies, even in times when there's a lot of new information coming in really quickly.
So we've gone through our market and economic overview and talked a little bit about what we're doing in portfolios overall, some changes we've made so far this year, and a little bit of a go ahead as we look forward. But we know there are some other concerns. So let's turn our attention now to the wall of worry. And Kelly, you had mentioned some other risks in the market. Chelsea, I know you talk to clients every single day. You have a pretty good sense as to what some of those key questions are. I want to turn it over to you to walk through a few of those right now.
Great. Yeah. First up on our wall of worry is the supply chain. People are seeing the effects of an interrupted supply chain in various areas of their lives, from the grocery store to home improvement. What happened and have we seen the worst of it?
The pandemic really hit the supply chain from both sides. So on the demand side, you had increased demand for goods because people weren't traveling or going out to eat as much. And then on the supply side, you had some COVID-related shutdowns that disrupted factories and ports and other parts of the supply chain. And these pressures showed up in the data as shortages, as delays for certain goods, and higher costs of transporting all these goods around the world. And this put some upward pressure on inflation. As people have started to return to more normal behavior, we have started to see these pressures start to ease a bit. So backlogs are improving, delivery times are improving, shipping costs globally are starting to come down a bit. And that seems to be the dominant trend overall for now, but it's something we're still monitoring closely. Right now, one of the main areas we're keeping an eye on is Shanghai. So the city is locked down. It's home to a very busy port, and you're starting to see some backups and delays at that port. So we just want to continue monitoring that for any potential spillover effects onto inflation more broadly.
Yeah. Yeah, we have the supply chain putting some upward pressure on inflation, but another contributor is these higher energy prices. So let's talk about energy for a moment. If nothing else, but because summer is coming up and we need to afford some road trips. So should consumers be concerned with prices continuing to rise? And do we have any exposure on the investment side?
Yes, these high oil prices are such a hot topic today. It can be easy to forget that not too long ago, during the height of the COVID shutdowns, the price of oil plunged so much that certain futures contracts even turned negative for the price of oil. And of course, since then, we've moved through this recovery. Oil prices have pretty swiftly come up. That was really amplified by the Russian invasion of Ukraine. And throughout a lot of that upswing, we did have meaningful exposure to oil companies. Since then, we've recently trimmed or sold that exposure. And our sell disciplines here are based on the idea that high commodity prices like we're seeing today can really plant the seeds of their own destruction. So a commodity producing company sees these high prices and decides, okay, prices are so high, it's worthwhile for me to invest in capacity a bit so I can produce more of this commodity. And we have started to see this capacity build out start to unfold. Of course, once people build out more capacity, supply of the commodity increases. And that ultimately, eventually drives down the price of the commodity. And that's when the returns for the stocks become extremely challenged and you'd want to avoid holding them.
That certainly takes me back to those Econ 101 classes with supply and demand. Kelly, could you elaborate a little bit more on Russia's invasion of Ukraine? It has certainly been a devastating progression of events to watch unfold. First and foremost, the humanitarian side of the war is unimaginable. And like you mentioned, with the impact it's having on oil, it seems to have many other ramifications. How does our research team view the conflict?
Yes, so the conflict has been dominating the news, and that's with good reason. The geopolitical and humanitarian implications are extremely extensive. And markets, on the other hand, have historically had a tendency to shrug off a lot of geopolitical events. We've seen this in Middle East conflicts, for example, and to a large extent, that has ended up being the case here. From a pure investment perspective, the key implication is really related to inflation. Both Russia and Ukraine export some energy and food-related commodities. Longer term, other countries might look at this conflict and decide that they want to spend a bit more on their own defense capabilities, which is also inflationary. So in a broad sense, this is really just one additional inflationary pressure that adds to the list of price pressures that we had already been grappling with and starting to deal with globally. So it didn't necessarily necessitate a change to our economic outlook.
Kelly, going back to your point that markets have a tendency to shrug off a lot of geopolitical events, I think investors will find it interesting that if we look at the close of the S&P 500 on February 23rd, the day before Russia invaded Ukraine, to the close of this past Monday, the S&P 500 is actually up 1.9%. It's crazy. So our last topic is one that I've been getting questions about constantly, and that is housing. If you're looking to purchase a new home, it's painfully difficult. Demand is high, inventory is low, and therefore prices are high. And to make things worse, interest rates on the average 30-year fixed rate mortgage have now hit 5% for the first time in more than a decade. And if you remember, 15 months ago, rates were at all-time lows. Investors have been asking, are we on track to see another 2008 financial crisis?
Yeah, so my friends who are looking for houses have really been not having a good time doing it. There's a lot of competition out there, and home building has started to pick up a bit in response to such strong demand, but actually building those houses remains quite expensive. And demand for housing is something we're going to be keeping a close eye on as the Fed continues to raise interest rates. You might have fewer people wanting to take on mortgages to buy those houses, but I do think it's important to highlight the differences between the increasing home prices we've seen this recovery versus what we saw in the housing bubble in the 2000s. First of all, the quality of the mortgage underwriting we've been seeing is much higher today than it was in the 2000s. So we have higher quality borrowers who are more likely to be able to actually continue to afford those mortgage payments. We also today don't have the layers and layers of complex derivatives set on top of those lower quality mortgages. So again, we're keeping a close eye on demand in the rising rate environment, but we don't view it as a source of major systemic risk like you had leading up to the '08 financial crisis. And finally, residential real estate gets a lot of attention because it's a big part of all of our personal lives. It's very relatable, but it's also important to remember that there are other areas of real estate that can be attractive investments. So for example, in addition to residential real estate, we also have exposure to things like data storage centers and even cell phone towers in some of our portfolios.
Well, Chelsea, Kelly, thank you. And before we turn to open Q&A, I do want to make sure that our listeners know if you have any questions, please feel free to reach out and have a conversation with your financial consultant. Or if you do not yet work with us, but would like to ask more about our perspectives or our services or our strategies and solutions, we're more than happy to get you in touch with your respective financial consultant team. I'll also point out that we do have a multitude of resources on these topics, some of which we highlighted earlier, such as the Tax and Wealth Planning Guide, which is designed to be your one-stop shop resource for getting your tax management house in order today. So next April is the way you want it to be, as well as other resources on our financial planning blog linked into the chat, including on topics such as dollar cost averaging, how to check up on your financial wellness, an ultimate financial planning checklist, and more. So we encourage you all to take a look and subscribe. And so with that, let's get to live Q&A. I do want to also give everyone a heads up that we will try to select questions that are as broadly applicable to the audience as possible. So if you do have a more specific question, again, we're happy to get you in touch with someone who can help you there. So how about this one here? I think I'm going to send it to you, Kelly, first, and then maybe Chelsea, you could weigh in. Do you believe that the traditional 60-40 asset allocation, or for us 55-45, still works? And if not, what would the replacement be?
Yeah, I think this ties in with what we were discussing a little earlier about the role of bonds in a portfolio in a low yield environment. Again, in our view, in severe market downturns, bonds, US Treasuries should still act as a safe haven asset and provide that downside protection you're after. But given where they're starting from, they might not provide as much protection as you've had historically. And this can be troubling for your traditional passive set it and forget it 60-40, 55-45, whatever it may be portfolio. And there are some less traditional asset classes that position themselves as something of a cure for some of these issues. And we are always exploring the entire investable universe. So for example, I mentioned we have some exposure to various forms of public real estate. We've also had some small exposure to gold, but the no free lunch axiom certainly applies here. You still have to be selective in what you're buying and be careful that some appealing higher return you're seeing doesn't come with a lot of additional risk that might not necessarily be immediately apparent just by looking at historical return data.
Yeah, and I'll chime in. We are in a tough investment environment these days, but what makes active management even more important in helping investors achieve their goal is activating this active management. And I want to go back to that toolkit that I mentioned earlier. And we have these additional tools that we can use to our advantage. We don't have a static asset allocation. We have ranges so that we can tilt to whichever asset class is more attractive. And then within bonds and stocks, we are able to move towards more attractive sectors. And then we find value in individual security selection. So
Yeah, absolutely. Yeah, no, Chelsea, great point. Having that discipline, framework to guide our thinking, but the flexibility with all these different tools, and you named a couple of the big ones right there that help us adapt. And obviously, COVID was one of the major wild cards that came out of left field and certainly shook things up. And we do have a question here from a listener asking about COVID, wondering whether we're concerned. So Kelly, you mentioned Shanghai earlier. Are we concerned about additional COVID flare-ups continuing to kind of throw a wrench in things?
Sure. So we're not epidemiologists. We've been well served by not attempting to be epidemiologists. And actually, right now, the most important factor seems to be not necessarily case counts themselves, but rather how governments respond to increasing case counts. So, for example, we had the Omicron wave in the US recently. There were some changes in consumer behavior, a little bit of a shift away from services, but the bigger impact was actually more related to the supply chain, especially in countries like China that have a quite low to zero tolerance for cases rising. So the thing that we're continuing to monitoring here is how those government policies evolve and the associated supply chain pressures that come along with the more strict policies.
Yeah, absolutely. Chelsea, I'm going to kind of put two together and send them your way. They're both the same effective question, though, and one of which is asking where or what is the best place to put money to work right now. And I do have another one asking, yes, where to also invest some cash that's sitting on the sidelines today of various quantities. So maybe just in general, do you have any thoughts on strategy there?
Yeah, when I get questions like this about putting money to work, I typically like to take a step back to figure out the purpose of those funds. Is the money needed in a year to purchase a vehicle, or is this for retirement in 10, 15 years? Since we can't predict the market, you'd want to keep money needed on the short term and emergency funds in cash so you don't have to worry about the dips in market. For longer time horizons, we found that using dollar cost averaging can be a good controlled method to allocating fresh assets. And that's essentially the practice of investing increments over time. So rather than trying to time the market to get the lowest price, you invest a fixed amount and buy however many shares you can, depending on the price of the time, in hopes of lowering your average cost per share. And we found that's a good way to get ease into the market.
Yeah, the ability to get invested is sometimes the most important decision that you can make. Another question here. So I'm going to read this. This one came through in the chat, actually. Should I turn to gold as an alternative to bonds, cash, in light of everything that's going on in markets and the economy right now? I know gold is always a common question that we tend to get. Kelly, do you want to shed some light on the value of gold in a portfolio?
Sure. Gold's got a lot of attention, especially following Russia's invasion of Ukraine. It's viewed as a safe haven asset and an inflation hedge. And inflation risk is, of course, a topic we've been tracking for quite some time now. So we did have some small gold exposure in certain portfolios prior to the invasion of Ukraine. It wasn't motivated by expectations for the conflict. It was based on our expectations for inflation, for interest rates, and other broad macroeconomic factors. And there are some different ways you can get exposure to gold. So in our ETF-based strategies, we took advantage of an ETF that owns the physical commodity gold. And in our bottom-up driven portfolios, we actually got exposure through gold miners. And today, we think having a small amount of gold exposure is worthwhile, but active management and appropriately sized positions are really, really important here. Safe haven assets like gold can provide protection in certain environments, but if you have an overly defensive portfolio for a long period of time, you're going to miss out on some more attractive returns elsewhere. So we need to stay nimble. So we closely monitor those economic and market conditions and adjust our portfolio as conditions evolve.
Yeah, it's about having balance and viewing the portfolio holistically from a strategic sense. All right, I'd like to squeeze one more in here. And again, I'm going to put two of them together. So I'll read this one exactly, and then the other question I'll lump in as well. When do you believe we will hit the bottom of the market, and why do you think that? And another listener had written in saying, do we think the market will be higher or lower 3 months from now? So looking for a little bit of the crystal ball. Kelly, Chelsea, maybe Kelly, you first, and Chelsea, if you've got anything to add, feel free to jump in as well.
Yeah, I wish I knew. I would be really extraordinary. Unfortunately, we don't know for sure. I've spent a lot of the past 45 minutes or so talking about getting more defensive, but even that is not a firm call that the market is going to decline tomorrow or in the next 3 months. And we do always closely monitor where we are within a cycle. But sadly, there's no neon sign that lights up right at the top or at the bottom. And that's why most of the time, the changes in our positioning tend to be incremental. We're changing it as new risks or opportunities start to emerge rather than flipping a binary switch on and off, risk on, risk off.
Yeah, and I know this answer isn't revolutionary, but it's really important to keep going back to why we invest, and that's for the long term. This is not one of those situations where you're all in or all out. And we'd love to be able to tell you for sure we're the best place to put your money for the greatest return, but unfortunately, the market is unpredictable. So that is why we have a process for decision making. And I love this quote, so I'll end on that. Time in the market is more important than timing the market.
I love that quote as well. I think that's a perfect place to wrap. I'd like to take a moment before we go and let all of you know we have a survey that we've put into the chat. We encourage you all to take it and provide feedback. We appreciate any and all feedback. It helps us make these events as effective and impactful for all of you each quarter. So again, the pre-submitted questions, the survey feedback, we thank you all for your engagement, and we appreciate the engagement we get every single quarter. And of course, we thank you, Kelly and Chelsea, for being here today.
Thank you.
And as a reminder, a recording of this webinar will be sent out shortly. Thank you all for attending.